As we sit here and digest the recent Fed statement and some economic data, including April's jobs report, investors are still on edge as tariff negotiations keep uncertainty in the air. With strong employment data on one hand and ongoing volatility on the other, how do you cut through the noise which is caused by things like geopolitical tensions and shifting trade policies and simply the market's nerves? Well, we're going to break that all down for you and more right now on UBS Trending. Hi again, everybody. I'm Anthony Pastore, and this is another episode of UBS Trending. Thank you so much for joining us today. My guest in the studio is Shannon Saccocia, who is the Chief Investment Officer of Wealth at Neuberger Berman. Shannon, great to have you join us in the studio today. Good to see you.
Thanks so much for having me.
Yeah. As I said to you as we started, this is really an eventful day for you to join us. We really just got the Fed statement for May. There's a lot to unpack there, and I just wanted to kind of go into that with you as we think about the most recent jobs report for the month of April, which was pretty good. Markets liked it on the Friday that it came out, but then you have the Fed coming out today, and I'm reading the statement. Unemployment rate has stabilized at low levels. Labor market conditions remain solid. Inflation remains somewhat elevated. They say they're definitely concerned about the economic uncertainty, and of course that's surrounding tariffs, et cetera. Just give me your first thoughts after hearing what Jay Powell had to say today.
Well, I think, first and foremost, the Fed absolutely had to say something in this statement that was a little bit different than the last one. I mean, you don't have a quarterly GDP print that comes in negative and not have to update your language. I think the challenge here is that the Fed has really tried to toe the line, particularly Powell and those in his camp. We could talk a little bit about divergence and differences with Waller, for instance, on having the necessity of balancing their two dual mandates. And I think there is a bit of asymmetry in that risk. I mean, I think they're certainly going to become more concerned about the labor market. But right now, and again, employment does tend to be very backward looking. Right now, even with weekly claims data, they're not being pressed to act on the employment side. And so I think what we're hearing here is that you're essentially saying, listen, we need more time. We know that we're seeing it in company reports out of the ISM. We're seeing it in micro data out of this past earnings season that we're in the midst of. Companies are feeling uncertain. They're feeling cautious. Some of them are feeling very concerned. That hasn't translated yet, and so they need to give themselves a wide berth to be able to counteract that.
Yeah, and it seems to be kind of trickling through the consumer as well. We were just talking about this where we're starting to see some slowdowns in air travel bookings, especially domestically, although you brought up a good point about cruise lines doing just fine. It's an interesting dichotomy to see, but it seems like consumers are also maybe keeping their purses closed, at least for the moment, or only opening it for the things that they really need. Is that just as evidenced by the fact that there is so much uncertainty that's happening right now?
Absolutely. And, I think if you look at consumer confidence, for instance, and I think we can pull that up here, there's been this perception that over the last couple of months, consumer confidence has soured pretty significantly. But it really has been fairly range-bound in a trend since COVID, right? So, consumers have been perhaps less confident than they were historically. Up to this point, they've managed to continue to spend. So I think right now what we're seeing in the underlying data is that consumers are cautious. They don't have that pent-up demand that, frankly, we've been spending down over the last couple of years. There still is an ability to spend, but I think you're right. I think what we're seeing is, I'm not sure that I necessarily need to step my foot in here and make those larger purchases, commit to a trip 6 months from now, because I'm not really sure what's going to happen in terms of, this nearer term economic situation.
Right. And, just before we got on the air, or I should say even this morning, Besant was saying that they were going to have meetings with China to try to come up with some kind of agreement or of sorts, but then President Trump came out just a few minutes before the Fed statement and said there's no wavering on the 145% tariffs on China. So that there's a lot of that back and forth that's happening a lot, and certainly for me as a consumer, I'm worried about what prices are going to cost, or even if we're going to get the goods here. We remember what it's like to have empty shelves during COVID, and so people, I think, are fearful of that as well. It's certainly a thing that is being talked about on Main Street.
Yeah, and scarcity-based price increases, and also the substitution we were talking about earlier, where you have an imported good and you have a domestic producer that has been competing with that. There's going to be some upward pressure on prices, particularly in the short term. The real question is that a 2025 phenomenon or is that a 25, 26, and 27 phenomenon?
Right.
That's where you start to get into those stagflationary scenarios. And I think it's important for, the viewers and to understand this is, is this a one-time price increase, which tariffs usually are, frankly, or is this something more insidious that we're going to have to deal with akin to what we dealt with after the COVID supply chain dislocation?
You look at the soft data, right? And the soft data tells us, yes, consumer confidence, business confidence is low. But I actually heard you in a recent interview, you were talking about that there's hope that maybe as we get to the back half of this year, we'll start to see some of that deregulation, things that businesses were excited about before Trump took office in January. What are the prospects of that? Do you see any of that potentially causing the markets maybe to think differently about what's going forward from here?
Well, I think it's actually, foundational to our view. If we shared some GDP scenarios, and they're pretty wide. I mean, those are a wide range of outcomes. But our view is that we're not looking or expecting a recession this year. And we're not expecting a recession because we do think that some of that pro-business deregulatory impulse, essentially this pent-up demand for growth by businesses. I mean, we're not seeing it on the consumer side, but we're seeing it on the business side. And so we do expect that to start to move through in the second half of the year. We haven't even talked about taxes, which I think is going to be the summer story. And a lot of the changes or expansion or reemergence of different things that are more pro-business in the tax bill, those can have meaningful, full expensing of structures, being able to, think about treatment of R&D, depreciation of that. Those are meaningful, especially for small businesses and innovative businesses who could really benefit from those parts of the tax law.
But interestingly, when you look at going back to those jobs numbers from Friday, wage growth was up a little bit, but average hourly, workers, the average hours worked, were steady. And which kind of shows that businesses aren't necessarily laying off people in anticipation of a slowdown. They're just kind of holding steady. They're not hiring, but they're holding steady. And maybe that should give us maybe some confidence that the businesses sort of feel like the environment can survive this uncertainty period that we're in right now. And obviously we have to get through to July when the 90 days of that tariff freeze is over. Lots more to come there.
Well, I think this is where precedent is really important.
Right.
If we hadn't had the disruption that we had coming out of COVID, and there hadn't been those massive layoffs and then rehirings that at much higher wages due to the huge supply-demand imbalance in labor, I think companies would be possibly announcing a few more layoffs than they're announcing today based on the uncertainty that we're in.
Yeah.
But importantly, you're not seeing that. And frankly, that is a meaningful part of this more sort of positive outlook into 2026 for inflation. And so, if you look at this business confidence, they're taking a step back. They're saying, we're going to wait and see. We're not going to announce significant new CapEx. We're not going to announce significant new hiring. But we don't want to be burned once again because many of these management teams were in seed 4 years ago, and saw what happened. And so I do think that we're not going to see that level of firing unless we start to see real economic deterioration and perhaps, our expectations, we probably get further delays coming out of the beginning of July. If we don't, you'd see companies act. The last thing I would say about the jobs report, which I think was a little bit missed in the narrative, is the number of individuals who were employed part-time for economic reasons actually came down in that report as well. So not only did you see steady hours worked, you saw people who were entering into full-time work that may have been part-time for economic reasons, which is actually a factor that that's a measure that the Fed looks at very closely.
That's interesting. You have to sometimes really dig through that data. I'm glad you brought that up because that is a really important factor when you think about the state of the businesses and the economy. I want to ask you also about, you have this really cool chart that you showed us about household net wealth. You said driven by equities, driven by real estate. Real estate is another big story. It's been since rates were up. What's the story with this chart? Because I think it says a lot about where we are right now as consumers as investors in the U.S.?
Well, I often get pushback on my consumer is more cautious and still able to spend because it sounds cavalier, especially with some of the lower income cohorts and the pressure that they've been under after several years of meaningful inflation. But the reality is that inflation on the asset side has helped to create a stronger base of household wealth. We also have seen, a lot of concerns about the housing market, right? And the inability of first-time home buyers and, people to kind of move out of their homes or get a bigger home. The reality is that that's also created a lot of wealth, that low inventory, that appreciation. And so if you look at the leverage for the individual U.S. consumer, leverage is way down from where it was prior to the great financial crisis. And so, you're coming, again, just like businesses came into this period from a position of strength from a liquidity standpoint, households are as well. So again, they may be cautious. I'm not going to argue that.
Sure.
I'm not going to say that retailers might feel some pressure to not pay these, additional price increases, but they're coming at it from a position of strength that I think is on both sides of that balance sheet.
Nobody talks about refinancing anymore because
Right.
I'm like in a 3% mortgage, so many people are. So it's, there's so many people who are locked in. Unless you have to move, you're probably going to stay where you are.
Right.
Renovations, on the other hand, are something that have gone up a lot because people are staying put, especially
Exactly.
right now.
And there was hope that would swing this year, but with the 10-year again kind of pushing upwards
Sure.
towards 5% a few weeks ago, people are. I do think that there is the one place where there's pent-up demand is in home buying,
Yeah.
right? And so at some point there will be
It's going to be an explosion.
right, but I think they're probably going to wait to see if the Fed cuts 75 or 150.
Yeah.
That is not my base case,
Right.
by the
What
way.
is your
Just
base case, by the way?
It's 2 to 3, so
Okay.
50 to 75 basis points this year. I think it really does hinge on what happens in the labor market
Yeah.
and around how much negotiation we actually get done in terms of those wider bands of outcomes.
Give or take. So we'll have to see how that goes.
Yeah,
Obviously,
and
there's a lot on the table.
I would say if we don't see that cut in June and we don't have that tax bill pretty much tied up in a little bow,
Yeah.
I think that's going to create some consternation for the markets.
That's probably a good word to say. Before I let you go, Shannon, this is
Sure.
awesome. I'm really enjoying our conversation. Just from a tactical, strategic, you want to look at it as an investor, with political uncertainty, with things that are happening right now, in the short term or medium term, where do you think investors should be maybe focusing right now?
Yeah, so I think there's a couple of trends that I think are really important. On the equity side, I think we've obviously seen, whether you question whether American exceptionalism are dead or just dormant for a shorter term time period, the reality is that, quality companies are, should be in emphasis, whether they're in the U.S. or outside of the U.S.
Yeah.
And so, this is not, probably not the time to be, investing in shakier businesses that don't have those strong free cash flows and balance sheets, that don't have a competitive advantage and a moat, and that haven't, frankly, taken care of their supply chain issues after the first round of Trump tariffs. So I think quality, number one theme. Number two is dispersion. I mean, you saw the story this morning on Apple and Alphabet about, search and the competitiveness of search and AI. So you're starting to see dispersion, not just in the Mag 7, but really across the market and opportunities for both, taking, long and short positions. The last thing I would say is fixed income. You and I mean, if you're anything like me, we spend a lot of our time talking about stocks,
We
right?
certainly do.
Equities are the focus. But if you look at the shifting curve, we're seeing a steepening curve. We're seeing some of those currency relationships that have been in place for decades start to shift with things like the Bank of Japan raising rates. Fixed income is really interesting.
Yeah.
And so maybe taking a bit more, like our view is like from an active approach, I may have had a sort of set it and forget it approach to fixed income. There's a lot of opportunity with the shifts that are happening in the currency markets, with the shifts that are happening at central bank policy, and then in the curve itself as we try to digest what could be one of the largest spending bills that we've seen in some time.
Yeah, Shannon, thank you so much. Great. I could keep going. There's so much to talk about. Great to have you.
Thank you so much for having me.
Yeah, this was a lot of fun. Thanks for being with us. And thank you to our partners also at Neuberger Berman for allowing Shannon to come and talk with us for a few minutes today. And thank you all for joining us. As always, we encourage you to, of course, check out our website at ubs.com/views for lots more content coming out of our great partners like Neuberger Berman and our own Chief Investment Office. Plus, you can follow UBS on social media. We're on LinkedIn, Facebook, and Instagram. You can follow us here in the studio at UBS Trending. Lots of content there. And don't forget, we always say this, but make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.